Yeah, so like Roshan mentioned, I'm Jonathan. I am a senior research analyst here, Phillip Securities, and together with the rest of my team, we'll be sharing just a little bit about what happened over the last quarter and what we think is or will happen moving forward, or at least the second quarter that we're in. So we'll just begin with a usual disclaimer that this essentially is just financial. It isn't financial advice. It's just for educational purposes. So we'll be running through, like I mentioned, the first quarter performance review, some macro themes that we've been seeing, and maybe some of the reasons why we're seeing it. We'll run through some of the sector themes, our stock picks, as well as sharing three of our new initiations that we've had over the last quarter, and then we'll finally end off with our usual technical analysis. Before we begin, feel free to post any questions in the Q&A tab below, and we'll try to get to it after the end of the presentation. All right, so we'll just begin with our first quarter recap. So essentially, the market continued to rally in the first quarter. Most people know this. S&P was up about 10% in the first quarter of this year, which is very impressive. Most of this again was led by Magnificent Seven stocks. So if you exclude the Mag 7 names, S&P would have been up 5 or 6%. So essentially half of the gains came from these 7 companies. Nvidia, interestingly enough, contributed to about a quarter of the total gains for the US market. So aside from this, the other thing that was a real surprise was actually gold, which surged 9% in March alone and was up 8% in the quarter. We think that it's mainly due to continuing geopolitical uncertainty, although it's actually not 100% clear why there was this surge, because actually the US dollar strengthened and there wasn't really any significant catalyst for this. So with interest rates, or rather with interest rate cuts expectations pushed back by at least another 6 months, the US dollar strengthened versus most major currencies. The most, against the Japanese yen. But nothing out of the ordinary here. In terms of sector rotation or your different sectors within the S&P 500, well, we added in semiconductors. They're not technically classified as a sector within the S&P, but the semiconductors continue to lead the way. They're up 29%, which is more than double the next sector, which is energy. Energy was led by higher oil prices, which rose quite significantly towards the back half of the quarter. We're starting to see a little bit of sector rotation take place. We can, the usual winners like technology, weren't really at the top of this list. You're starting to see some of the cyclical sectors, like I mentioned, energy earlier, financials, industrials, and materials. Some rotation going into these kind of sectors instead of and away from what had been doing well. At the bottom of the list, real estate continues to be battered, mainly due to high mortgage rates impacting housing sales, and this significant fear of the inability for REITs to get funding from a lot of banks due to high interest rates. Interestingly enough, also a lot of the interest rate sensitive sectors like utilities were down quite significantly, mainly as interest rate expectations got pushed further into the year. In terms of valuations, S&P 500 still looks a little bit overvalued. Just look at this chart here, which is this historical for the last 20 years. The average has been about 18 times, and right now we're trading about 21 times. So it is higher, but that's not necessarily mean that we'll see a correction immediately. Although the last couple of weeks we've seen quite a bit of weakness, and we think that over time this should start to even out a little bit, either by the index dropping or by earnings catching up. So right now we see sort of a wall in terms of valuation, so it's difficult for multiples to continue expanding relative to its historical numbers. So near term, we probably will expect some further consolidation or pullback unless earnings continue to surprise quite significantly to the upside. In terms of the S&P 500 versus your 10-year treasury yield, so essentially how we calculate this is your S&P 500 inverse of the price to earnings ratio of the S&P 500. So right now 21, it's roughly you get about 5 versus you take that number minus the long-term treasury yield, which is right now roughly around there. You kind of get this earnings yield spread. It's not really a predictor of how the stock markets will move, but it just tells you, in terms of equities relative to fixed income or for treasuries. Treasuries right now are looking more and more attractive, um, basically at 20 years lows. So quite a significant chart here, just to show, there is a lot of uh, there is a lot of risk in investing in equity markets, because there's not a lot of premium that you're really getting, even though you are paying a premium for it. Yeah, so that's all for the kind of quick first quarter update. We'll move into some of the macro themes that we're seeing right now. The most I guess important thing, or something that has been talked about every day, is the market's pricing in about 1 to 2 cuts in 2024. This significantly come down from the markets when they were pricing in about 6 to 7 towards the end of last year. And if you recall, during our last presentation, we did think that 6 to 7 was way too much. We were actually thinking somewhere closer to 3 cuts. We still think probably 2 to 3 cuts would be something that is a little bit um, uh, it's kind of what's in store for the rest of 2024. When you look at the general inflation numbers, it's come down quite a bit, and this is your core PCE numbers versus the Fed funds rate. So I believe that the PCE for March is actually coming out next week. So right now the 2.8 is actually from last month's numbers for Fed. But if you take a hint from the CPI numbers, you probably expect the PCE to come in, the core PCE will come in about 2.7, 2.8, somewhere in that range. Not really dropping that drastically. Meanwhile, the Fed funds rate has remained quite steady at about 5.3%. Over the last few months, has been at least over the last CPI numbers and the Fed Powell speech, it's quite clear that there still needs to be a little bit more signs of inflation coming down before the Fed starts to cut rates, and that's really what pushed the market further down in terms of expectations. So we think that inflation will continue to fall, although it will take a little bit longer to reach the Fed's 2% due to a more resilient US economy and a very tight labor market. So when we look at what's actually holding inflation up, and this is the chart of the CPI, which is in blue here, and some of its components. I just put housing and F&B, which is food and services, mainly because housing is almost 45% of the CPI. So housing makes up a significant portion of it. Essentially, what the numbers are telling us is that housing and food are starting to creep up a little bit, and that's really what was driving up some of the numbers in the CPI, and that's what is really holding everything up right now, as far as we can tell. Yeah, so like I mentioned earlier, market's pricing in 2 cuts. This is just a chart of the Fed funds expectations. So essentially, the market is uncertain whether cuts will start to come in July or September, so they're split on that, and then the same for November and December. Interestingly enough, what they're expecting right now is way off what the Fed had predicted towards the end of last year when they set the target for about 4.5% by the end of 2024. Yeah, so essentially, but of course, that's because the Fed hasn't really moved these numbers, but the markets are pricing this in, and naturally, markets price in a lot of things, and there's a lot of movements in terms of expectations whenever CPI numbers come out or whenever the Fed says something. So this is roughly in line with our thesis of somewhere in the 3 rate cut range. I brought this chart up the last time. Usually Fed pivots don't bode well for the overall stock market, and that's usually because the Fed cuts interest rates really quickly, implying that there is something wrong with the economy. So ideally, what we'd like to see is the Fed start to cut interest rates at a slow pace over a longer period of time, showing a little bit more sustainability and a more resilient economy. And we think that that's probably something that's going to happen over the next 2 or 3 years. That being said, it is unlikely that um, interest rates are going to be cut all the way to sub 2%, which is something that we've been having over a long period of time. We think that interest rates will remain fairly elevated compared to at least the last 15 years. You can see in this chart here, last 15 years, a big part of it was basically no interest rates or very low interest rates. And one of the reasons why we think that is like I mentioned earlier, the labor market is still fairly resilient. When we look at unemployment rate, it's still very low at about 3.8%. Anything below 5 or 6% is actually fairly healthy. And this is consistent with a lot of strong job data like non-farm payrolls coming out. When you look at wage growth, and this basically indicates fairly resilient U.S. labor market, U.S. economy. When you look at wage growth, it continues to moderate, although at 4.1% year on year, it's still a little bit higher than its long-term average. And so we think that this tight labor market and above average wage growth will continue to be a headwind for inflation due to the higher services prices, which is a big component of the CPI. And of course, this is also showed in a lot of the retail sales numbers as well. U.S. economy, or rather, the U.S. consumer continues to spend, and the only way they can spend that amount of money if they, I guess, are fully employed and are making enough money to do so. So moving on into our third macro theme, we think that there's earnings optimism, especially as the market rally starts to broaden a little bit. This chart is just a comparison of the S&P 500 trailing 12-month earnings per share over its forward 12 months estimates. Essentially, the spread are the bar charts in blue, while the S&P 500 is essentially the line in orange. And what we've noticed is that over time, as performance actually starts to or continues to be more positive than estimates, it really sustains rallies for longer. While the inverse is obviously the same. As performance starts to really underperform estimates, you usually start to see sharp corrections. In 08, 010. And so what we think when showing this chart is that as we look into 2024 and beyond, we think that we should expect to see the S&P 500 EPS continue to outperform its estimates slightly, which should be a good base for I guess a continued rally or at least growth in the stock market. And this is something that we're also seeing in terms of forward earnings, and it's starting to pick up quite significantly. I believe forward earnings for the last quarter essentially was for the next 12 months to grow about 11%, which is quite significant improvement over the last couple of quarters. And usually when there's this upside revision which continues, the stock market starts to go up a little bit. The biggest reasons for this, or rather a big reason for this, is because the expectation now is for a lot of the S&P 500 companies to be more profitable. There's a lot of benefit from AI, more efficient cost structures, and especially a more resilient consumer base. So this should help to increase the overall health of a lot of S&P 500 companies and the stock market in general. So that's it for the macro portion. We'll move into some of the sector trends that we are seeing. We've got 3 trends here. The first is EVs. We see a little bit of near-term pain for EVs, and it's quite well documented, especially in the news. So even though total EV deliveries continue to climb, you can see here, over the last 3-4 years, the compound annual growth rate is about 85%, which is almost a doubling every year. And the market is predominantly dominated by BYD and Tesla. What we're seeing is total deliveries for 2023 reach about 5.5 million units, which is a 55% year-on-year increase. So even as total EV deliveries continue to climb, what we're seeing is EV stocks are basically remaining quite stagnant over the last few years. So growth doesn't necessarily equate to, I guess, price performance, or hasn't really equated to price performance. Essentially, you look at the chart here, Tesla is in blue, BYD is in orange, and basically there's almost no movement. With Tesla is down about 20% over the last 3 years. Which it's quite weak for an industry that is growing at a relatively quick pace compared to a lot of other industries. And of course, one of the biggest reasons why we think that this is happening is because of the ongoing price wars. Like most industries that are in their infancy stage or early stages, there's a lot of competition. Um, so a lot of competition from Chinese EV makers, a lot of competition from your traditional ICE vehicle manufacturers, and it's really just sacrificing. All of them are sacrificing margins for volume, which in this day and age is really being punished by a lot of investors. And this chart really kind of shows it best. Over the last, essentially, this is a compilation of operating margins for some of the biggest EV companies. Um, you look at the operating margin continues to contract from a peak of about 11% now down to 8%. This 4% is a significant deal. Like it's a significant chunk of their profits just eroded by ongoing competition. So this is definitely a near-term worry, especially as EV deliveries. I showed you the chart earlier. It is actually starting to slow a little bit. Um, and so slowing deliveries plus contracting margins is really just not a good sign. I mean, lower volumes, lower margins, just bad for everyone. Just take a look at there's a good example of this would be a lot of EV prices, slashed by about 30% or more than 30% year on year. A lot of the dealers are actually selling EVs at a loss just to gain market share. So quite ominous in the near term. But aside from that, we still expect a growth trend to continue, although a slower growth trend to continue due to a largely higher base. We think that margins will also start to stabilize a little bit due to a moderation in raw material costs, continued improvement of cost of your batteries, and hopefully a slowdown or at least a moderation in the competition that is happening right now. So we're really looking at early indications of a bottoming in a lot of prices to give us a sign that yes, the price wars are kind of easing or actually kind of going away, and that should be one of the key indications to know when there's a turnaround in the EV industry. Aside from that, we continue to expect EVs to take market share away from traditional ICE vehicles because that's been a trend. They're growing a lot faster. I think ICE vehicles are growing 3% a year, while EVs are still doing your 40-50%. So quite significant difference there. In terms of our recommendations for the EV sector, we only cover Tesla. We have a neutral call on it with a target price of $175. Like I mentioned earlier, mainly China competition, a lot of margin headwinds from not just increased competition, but also they are starting to ramp up production or at least R&D spending and expansion to build their new cost-effective Model 2, which is going to be priced at around $25,000 US, and it's supposed to be for the mass market. And so whenever you ramp a new product like that, it does kind of eat into margins quite significantly. Lastly, we're seeing quite a bit of inventory build up, especially in China. There's just continues to be a negative, at least for pricing and margins. So that's all for the EV space. So move on now to semicon industry. We're starting to see semicons recovering slowly. We do this chart in our quarterly semicon update. The red box over here, you can see quite clearly that over the last 3 months and 12 months, there's significant improvements in worldwide semicon revenue growth. It is a little bit skewed because it is revenue growth and not unit growth. And so because a lot of the AI-related products like the GPUs are a lot more expensive, it is skewed quite heavily towards the significant demand from AI right now. Versus some of the other I guess non-AI products like your typical memory, your typical SoCs. And so we think that the recovery of other components like memory and equipment will lag slightly, but it seems a lot of these segments seem to have already bottomed and a little bit more upbeat especially commentary from a lot of these companies moving into 2025. So, like I mentioned, the recovery is still not broad-based yet. This is just a summary of the quarterly earnings for a lot of the semiconductor companies. Most of the recovery in this box over here is just GPU processors, NVIDIA, AMD, a little bit of Intel. When you look at the rest of I guess memory as well has done a little bit better. When you look at equipment as well as foundry, you still see a bit of weakness there. And so, we are still waiting for the rest of the semiconductor industry to pick up. Right now, we're not really seeing it yet. A lot of the commentary is more for 2025. And so we think that, in 2024, AI will still be the main driver, at least in the next quarter or so. So just another chart to illustrate, semicon, AI GPUs are expected to grow, 200% in terms of sales for this quarter that's just passed. Waiting earnings from some of the big guys, AMD, NVIDIA. When you look at memory and CPU, these numbers are still pretty flat. Still improvement from maybe the beginning of last year, but still not really seeing growth. It's still kind of contracting a little bit. And so we do expect, and generally we do expect some slower a recovery of your CPUs and memories and equipment to be a little bit slower, just based off just how the market works and how the hype is right now. But we should start to see some sort of flow through in terms of demand for especially memory, because AI GPUs and AI processors require a lot more memory than just current processors right now. So the word from SK and Samsung is that they are ramping up production quite significantly to meet this need. And aside from memory, you've got we should start to see a flow through into a lot of your equipment, not equipment manufacturers, but data center equipment. So maybe like some of the racks that are used to house servers or server hardware. We should start to see a little bit of flow through demand into these kind of, I guess, niche products instead of just your AI GPUs that everyone. So good sign for the semiconductor industry. Recovery is still in the early stages, and we look forward to more participation across the industry. In terms of our recommendations, we cover NVIDIA and AMD. We have a buy call on NVIDIA at $970 US. It is actually one of our stock picks, so I'll talk a little bit more about it later. For AMD, we have an accumulate at $195 US. For AMD, one of the reasons why we like NVIDIA more than AMD is because NVIDIA is the dominant player. AMD has 8 to 10% market share at best. Plus, most of their business is actually, I guess, relying on your traditional businesses, like your not traditional, but your other businesses that are not really AI related. So you talk about gaming, your traditional AI servers, traditional CPUs, and stuff like that. So that's all for me. I'll hand it over to Ambrish to talk about the SaaS sector, as well as go through some of his stock picks. So Ambrish.
Thank you, John, and good evening, everyone. So let us now take a look how the SaaS companies have performed. Next slide, please. Thank you. So basically, SaaS, it's basically an abbreviation for like a software as a sales service companies, and they basically deliver their software over the cloud, and as a result, they have a recurring revenue business model wherein they generate monthly subscription fees from the customers. So for SaaS overall, we have divided the companies into 3 categories, namely ERP, enterprise resource planning, customer relationship management, and productivity. And this chart basically depicts the year-over-year sales growth for these companies on a last 12-month basis. So basically, if we take a look at the green line, it's for the productivity segment, and it includes Microsoft and Adobe, and it's leading in the recovery. And this was mainly because of the strong demand for its cloud infrastructure services like Azure, as well as productivity softwares like Office 365. And also, there have been continued demand for designing applications from Adobe. And during pandemic, enterprises, these companies, they remained resilient, reported resilient revenues, and this was mainly because the enterprises, they did not cut down on their spending on these applications. Whereas the blue line is it's for the ERP segment, which includes Oracle and SAP. And during pandemic, it had remained under pressure, and the revenue growth rate was almost flat in the fourth quarter of 2020. And right now, it's still under pressure. Its revenues are growing by about mid-single digit range, and it's mainly facing headwinds or challenges mainly because of the shift in like customers. They have been shifting to a cloud-based solutions from on-premise software licenses, and as a result, it's still facing challenges. Whereas the red line, it's for the CRM companies like Salesforce and HubSpot. And these companies, they basically provide customer relationship management solutions as well as marketing and sales solutions to large and small and medium enterprises. However, the revenues for these companies, they have been declining, and this was mainly because the cautious IT spending from the enterprises, mainly because of the macro uncertainties. However, we believe that this seems to have bottomed out. So overall, most of the software companies, they have integrated AI across their products, but we believe that any material contribution from AI tools it's still awaited, mainly because the companies, they are still right now focusing on increasing the customer engagement instead of monetization. So, for instance, like Office, Microsoft, it has integrated Office 365 AI tools, like wherein you can generate the first draft of presentation or generate text in Word. But the company, it has still not provided any metrics or any how these are contributing to its top line growth. So apart from the cloud infrastructure growth, we are still SaaS sector. It's still awaiting any growth from the AI component. So next slide, please. So in terms of recommendations for SaaS, we currently cover Microsoft, Salesforce, and Adobe. And we have an accumulate recommendation for Microsoft and Salesforce. So I will cover these two companies. These are one of our stock picks, so we'll cover later on. So for Adobe, we have a reduced recommendation mainly because the valuations, we believe that they were a bit overstretched, and market expectations were significantly high in terms of its AI contribution from its tool, which is PhillipCapital. But we believe that the revenue growth rate for Adobe, it has been constant, and in fact, for the March ended quarter, they have guided for the drop in its revenue growth rate to below 10%, and they said that this was mainly because of the tough comparisons. And so basically, the price hikes which were previously announced in 2021 or so, they hit the customer base last year, and as a result, they might have started to roll off now. And also, we believe that like I mentioned earlier, like it has like integrated Firefly into its like a products wherein you can generate image from a text-based prompt. So company, it's still like we still need to wait and see how the company, they can convert its free users to the paid users. And it also faces competition threats from peers like Mid2 Journey, who and Delhi, who can also provide who can also generate images from text-based prompts. So next slide, please. So moving on to our stock picks for the second quarter of 2024, we have 5 stocks, namely Alphabet, Amazon, Microsoft, Nvidia, and Salesforce. So let's begin with Microsoft. Thank you. So for Microsoft, basically, like there are two main growth drivers for Microsoft. So first of all, it's cloud service, which is Azure, and secondly, it's Office 365 productivity software. So Azure, it's basically a component of its intelligent cloud segment, and Azure, it has a market share of about like 24%, and it's the second largest cloud service provider. And the market share has doubled over the last 5 years or so. So we believe that the company, it should continue to gain market share from its peers like Google and Amazon's AWS, mainly because the enterprises, they are shifting their workloads from on-premise to the cloud, as well as it also provides integration capabilities with Office 365. And also the enterprises, they get access to the large language models from OpenAI, wherein they can build their own applications. So for instance, like if a company it wants to integrate AI chat assist, AI chat tool in its website. So through this OpenAI's language model, they can integrate or develop their AI tool function and integrate it into its products. So we believe that the increasing interest in LLM models could help benefit Microsoft. And also Azure, it's a high margin business, and growth in this segment would also improve Microsoft's profitability. Whereas the green line, it's for the productivity and business processes segment. So this basically includes the Office 365 productivity software. And despite the significant market share in the product, 90% market share in the productivity segment, the Office 365 revenue, it has been consistently increasing by about a 15 to 17% range each quarter. And we believe that this was mainly because of continuous product enhancements, like it has integrated AI tools, and also it has been there has been increasing demand from the small and medium enterprises, in order to rising demand for to meet the tasks and workflows. And lastly, the red line for the more personal computing segment. So it has been witnessing drop over the last 3 quarters or so, mainly because of the weak PC sales. But it has now started its bounce back, and we expect a recovery in the second half of 2024. And mainly because we believe that Microsoft is expected to witness like a upgrade cycle, wherein more the most of the pieces currently they have been bought like about during pandemic or so, and people might consider upgrading it maybe in the second half of this year, when more AI powered personal computers would be launched. So we expect a continued recovery for the rest of this year for this segment. So for Microsoft overall, we have an accumulated recommendation, and we have a target price of $450. Next slide, please. Thank you. So moving on to Salesforce, Salesforce also basically generates over 90% of its revenues through subscriptions, and it basically helps companies with enhance their customer relationships and provide solutions for sales and marketing solutions. So for Salesforce, like it has been we're witnessing continued demand for its core products, which are Sales Cloud and Service Cloud, as well as the fastest growing segment currently. It's a MuleSoft product, which basically helps to integrate the data for companies. And currently, what Salesforce is doing is instead of selling each as an individual product, it currently selling it as a multi-product, selling multiple products, cross-selling its products to its existing customer base through its platform, which is Customer 360 platform. So, which is basically a fully integrated one point of solution for the customers. And as a result, it's helping the bundling strategy. It's helping Salesforce to increase its average selling price, whereas it's also beneficial to customer enterprises, mainly because instead of managing various vendors, they have to just be manage one vendor, which is Salesforce. So, and it also been introducing new features, it has also integrated AI across its product base, wherein it could generate sales emails, or generate meeting notes and schedule meetings. So right now also the Salesforce, it has announced a price hike of about 9% last year. So this was the first price hike which the company has announced over a period of last 7 years or so. So we believe that this should provide a top line growth to Salesforce at the end of this year, when the customers' contracts they are due for renewals. And lastly, Salesforce, it's also focusing on margin expansion, wherein the margins they are continuously expanding over the last 2 years or so, and this was mainly because its continuous focus on increasing its profitability through cost-cutting initiatives, wherein like last year the company has laid off about 10% of its workforce and also shut down a couple of its offices. So these have been it's witnessing full effect of these cost-cutting initiatives now, and as a result, its margins are likely to grow in this year as well as next year. So overall for Salesforce, we have an accumulated recommendation and a target price of $323. So it's mainly because it's margin expansion as well as there's rising multi-cloud adoption, and also it's like focusing on maximizing shareholder returns. Like in the most recent quarter, it announced a dividend per share of about 40 cents. So with the focus on increasing shareholders returns, we have accumulated recommendation on Salesforce. So that's all for me. I would now like to pass it on to Jonathan.
Yeah, thanks, Ambrish. So I'll take over and start with Alphabet. So for Alphabet, is the story is really three main things. One would be a continued recovery in digital advertising. Two would be leveraging AI technology for better growth, increase efficiencies. And three, from a valuation standpoint, we still think that that there's still a little bit of upside there. It's not too overvalued. So I'll start with the first one. A recovery in your digital advertising industry. I mean, just for some context, Alphabet is essentially a monopoly in many of its industries. Just talk about Google Maps, Android, and so on. In terms of digital advertising, it's not a monopoly, but it has a majority market share. The main when you think about digital advertising, guys, you think of Alphabet, Meta, I guess to some extent Twitter, or rather X. You've got Snapchat and Pinterest and so on. So there are a lot of smaller players, but Alphabet is really the main one that comes to mind. And what we've been seeing over the last quarter or so is that revenue continues to climb steadily, with growth actually accelerating over the last 3 quarters. Last 3 quarters. We look at this chart here. It's your revenue chart over the trailing 12 months in blue. In orange, it's your operating margins, and the green arrow is just kind of the historical trend line of how revenue should be growing. What we're starting to see is also ad revenue that is steadily improving over the last 4 quarters as well. So not just 3 quarters, but 4 quarters. Although growth is only at 11% year on year, which isn't, like, I guess, compared to what it was in the past, growing like 20-30%. It's not quite there yet, but we still see a steady improvement, which is really good for a company of this size. Secondly, leveraging AI technology and integrating it into a lot of its products is something that helps Alphabet kind of stay ahead of the curve, if you think about it. It's also improving a lot of monetization for some of its products, like YouTube Shorts. It's digital advertising business in general, because you leverage AI to give you better ROI for advertisers, increase efficiencies. Naturally, you can charge advertisers a little bit more and gain a little bit from that. At the same time, a leaner cost structure over the last year or so has led to much better efficiency. Not so much redundancies. A lot of these redundancies actually have been replaced by AI to the most part. You can see that operating margins of about 20%, almost back to its pandemic peak of about 32%. It's not that far off. We'd expect margins to continue to improve, especially as the company becomes more and more efficient, with every dollar, I guess, contributing less cost to a certain degree. Lastly, in terms of valuations, right now it's trading about 21 times 4P, which is in line with its average. We think there is still a bit of room to run, given a lot of the continued investments in AI that to support future growth. At the same time, we do also expect earnings growth to continue about 25% compound growth rate over the next 2 years. So that plus the market dominance that it has, it's very difficult to erode that moat and that market dominance. We have an accumulate rating with a target price of 154 US. So my next counter would be Nvidia. I think it's really need that much introduction. Essentially, Nvidia is still massive growth story. At the same time, margins are extremely high for a company of this size. I mean, gross margins are about 75%. Your net margins are like 50%. So for every dollar that they earn, they essentially earn that they keep $50. Every dollar, 50 cents for every dollar. It's quite crazy to hear of from such a large cap company. And lastly, valuations are also fairly attractive at 36 times for PE. So it's actually roughly in line with its 10-year average. I think the biggest thing, the biggest question on Nvidia is whether growth can be sustained. And we think that yes, definitely growth can be sustained. I mean, not at 200% year on year, for the foreseeable future, but at least high growth can be sustained in the long run because a few things. Firstly, the company is building a much better ecosystem with more diverse range of products. So for right now, most of what you're hearing of is the GPUs. But they are also building up a foundry service internally. They're also moving into custom design chips. For certain hyperscalers. And with more products, generally you have a more diverse range of customers. So it's not so heavily concentrated to a specific geography or a specific industry. At the same time, when you look at some of what investment plans that hyperscalers are thinking of, the newest one from Microsoft is actually they're thinking about their $100 billion Stargate project. It's actually, when customers like these are planning to spend that much money, a big chunk of it will have to go into hardware to support it, and that's where Nvidia kind of comes in. And so as long as the demand continues to flow, and this is something that we continue to see at least in the near term, we do expect growth to be sustainable, or at least valuations to be sustainable by the high growth rate. So because of that, sorry, another thing that they do really well is they have a very aggressive product rollout strategy. So what they do is that they roll out new products, every 1 or 2 years, and generally, if you think about what happened and it just happened last month in their GTC event, they launched a new Blackwell chip, which is supposed to replace their older Hopper H100. So they keep on. It's going to be more efficient, more powerful. Of course, they're going to charge a little bit more. But what this does versus the competition is that the competition is always playing catch up. And so if you are always producing the best products ahead of the competition, you have the pricing power to charge them more, and they're willing to pay because there's still so much demand for it. Naturally, you'll be the biggest winner, and that's what we're seeing right now. And as long as we do think that the engineering capabilities and the team at NVIDIA is very strong, and they'll continue to do that, at least for the near term or foreseeable future. So that's why we have a buy rating on NVIDIA, target price of $970 US. So that's all for me, at least for my stock picks. I'll hand it over to Helena to just run through Amazon very quick. Thank you.
Thank you, John. So I'll be sharing on Amazon. Just a little bit background. Amazon is an American multinational tech company that mainly engages in e-commerce and cloud computing. So the main two pillars of the company are retail, namely its e-commerce service, and Amazon Web Services. When it comes to retail services, it currently accounts for around 85% of the company's revenue. So its operating income improved more than triple year on year in the last quarter. This is largely driven by their continued efforts to improve efficiency and fulfillment process. So they have their plan of regionalization, which is the expansion of last mile delivery facilities, with the aim of shortening delivery time and lower transportation distances. And they have been quite successful in doing so. Their same-day delivery increased by 65% year on year, and their cost to serve declined by around 45 cents per unit. Of course, this is also partially because they're facing lower fuel prices. So with these improvements in efficiency and reduced costs, we're seeing improvement in margins So both their gross and operating margins improved significantly from the low levels in the fourth quarter of 2022, with their operating margin expected to reach the pre-pandemic level of 6 to 7%. Moving on to their second pillar, which is their web services. AWS revenue growth has been dipping in the previous few quarters because consumers are moderating their spending. But we're rather bullish as the effects seem to have been bottomed out. AWS growth start to show signs of stabilizing due to the mega trend of adopting generative AI in general. And of course, consumers start spending again. So we start seeing accelerated new deals and backlog conversion. Their order backlog grew around 40% year on year in the last quarter. So we believe that AWS is in a very good position to attract more consumer spending. The reason is AWS still has the largest market share, so it's easier for them to attract new customers. And for the existing customers, because it already has a lot of customers already storing their data on AWS, and the switching cost is quite high. So it's likely for these existing consumers to stick as well. And also do know that AWS, they have a much higher operating margin, which is around 29.6%. So this is much higher than the operating margin of retail, which is only single digit. And right now, majority of the company's revenues still come from e-commerce. So with AWS slowly sizing up, we believe that it will push the company's operating margin to even higher. Last point I would like to add on is advertising. We believe advertising remains a great growth opportunity for Amazon because advertising has been growing strongly at double-digit year on year. So Amazon has been trying to improve its ad relevancy, which drives up the ROI for advertisers. They're in a pretty good position to do so as Amazon is able to collect its own first-party data. They have also started trying to monetize through advertisements, seeking more ways to expand their revenue stream. They recently started charging ads in Prime Video unless you pay a fee of $3 per month to filter out the ads. So there's still a lot of room to grow as advertising only contributes 8% of the company's total revenue right now. And advertising is something that has the ability to scale alongside with the retail business. So to sum up, we're pretty bullish on both retail and AWS segment of Amazon. And we also think that advertisement can be a good growth opportunity. So overall, we think Amazon has a pretty compelling profitability narrative, and hence we maintain our buy recommendation with the target price of $215 US. So that was the end of our stock pick. Now I'll be passing my time to my colleague Dan to talk about our new initiative.
Hey, thanks, Elena. Yeah, so we initiated on the three sort of largest US banks, mainly JP Morgan, Bank of America, and Wells Fargo. I think there was a question in the chat asking what is our rating and what does this accumulate by neutral, or what does this mean, right? So I'll just maybe touch on that before I move on. So basically, we're looking at returns of more than 20%. So our target price and dividends over the current share price, and accumulate is within 5 to 20%, and neutral will be -5 to 5% increase. Yeah. So we hope that clarifies and maybe it'll be clearer for those wondering, what does it mean when we say accumulate and buy? Okay, so moving forward to the next slide. Please. Yeah, thanks. Yeah, so we did initiate on the 3 US banks. Moving on to the next slide. Yeah, so for the US banks, just in general, for the 3 of them, we do have 3 investment merits. The first one being the exceptional market share of these 3 banks, JP Morgan, Bank of America, and Wells Fargo. So they are the leading banks in the US and they hold around 40% of the total assets in the sector. So that's just slightly below half of that. That's really quite big for these 3 banks. And as of FY23, JP Morgan does have the biggest market share at around 17%, followed by Bank of America at 14%, and Wells Fargo at around 9%. And they also lead in their loans and deposits as well. So the 3 banks hold around a third of 28% of the total loans. And in deposits, also roughly a third at 32% of total deposits. And you might be wondering, whether the bank failures that recently happened, would they affect these banks, or is it just the smaller banks? So interestingly, in 2023, when there were quite a number of bank failures, these 3 banks actually increased their share of their total assets. So for total assets, it rose to from 38% to the 40%, and for deposits, it rose from 31% from 31% they're up to 32%. So it's a slight increase. So actually all these bank failures are beneficial for these US banks, and their dominance does allow them to handle a significant number of transactions and deposits across all of their business segments. Hence, being big is actually one of the benefits of these banks. Now, moving on to the next investment merit for the US banks. Yeah, so another question that I think I'll get quite a lot would be, wouldn't the peaked rates actually be detrimental to these banks, since they earn quite a bit from their net interest margins and net interest income? So surprisingly, we feel that peak rates are actually a catalyst for these banks. So in the Fed's pivot from this aggressive rate hiking cycle to a potential rate cutting stance in 2024 is actually quite a significant catalyst for these three banks. In early 2022, the Feds did raise their rates very aggressively, and no doubt these banks were immediate beneficiaries, as the assets that they had tied to the benchmark lending rates were immediately repriced to pay the bank higher rates. So we can see this in the dark blue bar here. It actually shot up and it's surpassed the growth of the repricing of the cost of funds. So, but this is mainly due to the bank's deposit cost lagging. Hence, there's this huge gap, and you can also see the green bars here. That is the net interest margin for the banks. It also rose respectively, together with this rise in the interest rates. However, currently this has sort of reversed. You can see the lines overlapping and sort of getting very close, because the cost of funds repricing have started to exceed the asset repricing. Hence, there's a drop and a stagnation in their net interest margins across the whole banking sector. So with this rate reaching their peak levels, and with some potential rate cuts in the second half of the year, we do expect that the asset repricing will start to overtake the lead from the deposit repricing for at least the second half of the year. And we might see NIMs start to improve again instead of being in this sort of sideways movement. Yeah, for the last investment merit I have for the banks, at least, it will be that there's a benign provisioning cycle. So the bank's management of credit losses have normalized from the unusually low levels that we have seen during the pandemic. And you can see this, the dark blue and this orange line here, it's coming back up, but it's actually back to the sort of a normalized level. So we do not see any signs of significant credit quality deterioration. And of course, some losses are anticipated from the commercial real estate sector, but these banks, at least the three big ones, have been monitoring these portfolios as well closely, and they have also set up specific loan loss reserves for them. And additionally, I have another chart, but I don't have it here, but there was also no overlending in 2023, as we have seen that the nominal GDP growth did outpace the loans growth. So we will probably not see any further creep up in this credit quality deterioration. So now moving on to the next slide. Yeah, we also did sort of a comparison of these three banks, and like their size and their geographies, and how much of their revenue comes from what segment. So for JP Morgan, they are the largest bank in the US, and they do have the highest international presence amongst the three banks. And its revenue is also quite split between down the middle at 56% in net interest income and about 44% in their non-interest income. And for Bank of America, which is the second largest, it leans more towards the net interest income at around 58%. And they also have, not really surprisingly, but they do have a much larger proportion in the United States, 87%, compared to JP Morgan is only around 38 to 40% in North America. So JP Morgan is more geographically diverse, I would say. And lastly, for Wells Fargo, they are more towards the consumer, so they do stand out with its extensive branch network, and as well as a significant contribution from their net interest income at 63%. So that is the highest contribution amongst the three banks. And if you look at their branches, the number of branches, they only have around half the assets of JP Morgan, but they have nearly as many branches as compared to the largest bank in the US. And this is indicating quite a strong middle market presence, as well as a potential for deposit growth. Now, moving on to the next slide, I think we'll go straight into the banks. Yeah. So for JP Morgan, I think I won't really, since I covered the three banks, I'll just speak briefly about the three investment merits we have for JP Morgan. So the first one is that they have very strong and consistent earnings, and they have consistently outperformed their consensus expectations with its EPS, even with its most recent first quarter earnings. And this is the ability to sort of exceed the expectations for 6 or now 7 consecutive quarters demonstrates the bank's resilience as well as adaptability in various market conditions. And secondly, they also have a positive net interest income outlook. And they are looking at an outlook for 2024 for a higher than expected net interest income of around $90 billion US dollars. They have not actually changed it in their first quarter guidance. And even though they are expecting around a few 25 basis rate cuts, they are still maintaining this positive net interest income outlook. And lastly, there's also a continued share repurchase. So they have planned to continue their share repurchase program at the current net pace of around $2 billion US dollars per quarter. And their common stock repurchases did rise 217% year on year to around $10 billion US dollars in FY23. So if we are assuming that their share repurchase program is maintained at the current pace, we could see their FY24 EPS rising by around 2.5% year on year. So as such, we did initiate coverage on JP Morgan with a buy, as well as a target price of $231.19. Now, moving on to the next counter, I think it will be going to, Bank of America. So for Bank of America, the 3 investment merits again. The first one would be they have a manageable net interest income decline, as well as a slight expense growth. So their 2024 outlook points to manageable declines in their net interest income in the first and second quarter before they start to see some modest growth in the second half. As I mentioned earlier, how we are expecting that the asset repricing will start to overtake the lead from the deposit repricing. So they have also are looking to see that happen in the second half. And in addition, the expenses are also only expected to increase modestly. For the second investment merit we're looking at would be the effective loan portfolio management. They have seen a 1% year-on-year increase for FY23, and this indicates that the bank has been effective in expanding their loan portfolio while managing the associated risk. The last one would be the sound asset quality. So despite their non-performing assets as well as their net charge-offs being higher, their provisions for credit losses was actually better than anticipated. And this suggests that they have been able to effectively manage their credit risk, ensuring that potential losses from bad loans are adequately covered. So as such, we do initiate coverage on Bank of America with an accumulate as well as a target price of $40.82. Now for my last counter, that would be the last bank, and that is last but not least, it will be Wells Fargo. So Wells Fargo, similarly, the 3 investment merits, we'll start off with their guidance for potential decline in net interest income, but this is going to be expected to be offset by a modest growth in the second half of the year. So we will see probably a flattish NII net interest income for the year, and they also do only expect a slight increase in their expenses. We also see a resilience in their fee income, and this is mainly due to the introduction of new card products, which has stimulated an increase in customer expenditure. They have also been channeling investments and expanding their workforce in the corporate and investment banking, so particularly in trading. So we have actually seen that in the first quarter as well, and this has led to a rise in both revenue and market share. And lastly, share buybacks again. So they did note that buybacks will increase compared to the 12 billion in FY23. So their common stock repurchases rose 98% year on year to around $12 billion US dollars in FY23. And if we do assume a rather modest increase of 10% year on year for FY24 for the repurchase program, we could see the FY24 EPS actually rising by around 9% year on year for FY24. Yep, so we do initiate coverage with an accumulate as well as a target price of $57.13 for Wells Fargo. That's all I have for the US banking sector. I'll now hand it over to Zane for the technical analysis. Thank you.
Thanks, Glenn. I'll move on to the technicals of the Nasdaq as well as S&P 500. Next slide, please. Yep. So looking at the Nasdaq, currently we are seeing a pullback from a double top at the 16,200 point level. And this week wise, we actually saw a breakdown of the short-term uptrend channel highlighted in blue. So in this indicates a short-term pullback in terms of the bullish momentum. We think that we could see the index pullback of a little bit further towards near the 15,000 mark where it's a good support level, where it's the main uptrend channel support, as well as a horizontal level, which the index broke out of in January, and it did a successful back test before heading higher. So our take for this quarter is that the Nasdaq could pull back further towards this support before a rebound taking place. Something similar to what we saw in previous corrections in February to March last year, as well as in August to October of last year. That brings our second quarter target to around 15,000 to about 16,500. Next slide, please. Yep, so next one is on the S&P 500. It's a similar story as well. Currently, S&P 500, we are pulling back from the main uptrend channel resistance at the 5,200 point level. The past 2 weeks, we also saw a breakdown of the short-term uptrend channel in blue as well. So we think that S&P could still see a further pullback close to the 4,800 point level, which is a key support level that was a prior all-time high resistance back in early 2022, and the 4,800 level was also a resistance breakout level which occurred in the middle of January this year as well, following a range consolidation at the start of this year. And the 4,800 level as well is also it also confirmed with the main uptrend channel support as well. So we could see a little bit further pullback towards this support before some rebound towards near the end of this quarter. That brings our second quarter target to about between 4,800 to about 5,100. So that's all from me. I'll hand over time back to Jonathan to wrap up the webinar. Thank you.
Yeah, thanks, Zane. Just to conclude, inflation is stickier than expected. We're looking for a tougher road ahead compared to what we initially expected when inflation started coming down. Valuations, are a little bit overstretched and kind of a wall to further upside, at least in the near term. Because of this, we do expect some sort of weakness in the markets as well as increasing volatility in the second quarter. Also, especially as we come closer towards, I guess, election campaigns kicking off. Plus, there is still quite a lot of geopolitical tensions escalating. So with that, I guess we'll conclude today's webinar, or at least the presentation, and then we'll just move on to Q&A. Just another reminder, if you have any other questions, feel free to post it in the Q&A tab and try to answer it. If not, if you ever need to reach out to us, feel free to contact us, scan the QR code, or send us an email. At the same time, we're also on community groups on our Poems Mobile 3 app. So if you are on there, you can also send us questions there. We'll try to answer it as soon as possible. So with that, let me get to the questions. Okay, so the first question here, we'll just take it chronologically for the most part. SMCI and NVIDIA overvalued given the fact that their growth rate is high of double digits. So I can't really... I guess for SMCI, I believe, yes, they are a little bit overvalued, but at least for NVIDIA, you look at forward earnings like I showed just now, 36 times, 35 times, doesn't really seem that bad considering the fact that their growth rate is actually going to be a lot higher than that. So if you just, a very common ratio to use is like your PEG ratio, your price to earnings growth, and you just take that, less than 1, seemingly undervalued. Over 1 is overvalued. But if you even just take the historical trends, 36 times is really, I want to say either somewhat fair value or even a little bit undervalued given the significant upside to AI and the current demand that we're seeing right now. How would Western digital split affect the share price? So it essentially, sorry, let me Google this real quick. I don't really know what's the split like, but it doesn't affect your essentially the share price will just be split into okay, so I don't really know how the share splits will affect the share price, because they're going to be split into two different companies, one on ACD and one on Flash. Yeah, so I can't really give you an answer here. Sorry, I thought it was a stock split. But essentially, you probably have to wait for further clarification. But usually the company will issue, if they do 50/50 or whatnot, the stock price will just be split accordingly to the assets or to how they want to do it. Usually, you either get option of converting your shares, from one company to another company, or you'll just get both shares, both different independent companies. Sorry, I didn't get your question 100%, but yeah, hope that helps. Yeah, another question here. Hi, Jonathan. FFR, Fed funds rate, possibly only one rate cut at 0.5% instead of two at 0.25 by the end of the year. Yeah, so I don't think it's going to be, the Fed is going to be cutting 50 basis points at one go. Given the stance and the commentary that's coming out of them, it's more likely that they'll kind of just take it slower, just to make sure that they don't cut too fast, too quick, too much and too fast. Yeah, because the thing that I guess worries them is that the economy is still fairly resilient. So if they cut rate too fast, it might increase demand too much, and then you'll get the same problem of having inflation creep up again. So most likely, they'll just take it 25 basis points at a time and see where that goes. Another question here. Tesla greater than BYD. So I think if you are looking at more of a stable, less exciting company, you probably want to go with BYD. They do have quite a lot of upside, but I think when you look at if you want more volatility and even greater upside, then Tesla will probably be, in the long run, will probably be a greater bet because they've got more levers to pull. Not just from I guess automotive or auto company standpoint, but more from a software standpoint, greater margins there, greater potential for earnings. At the same time, once they start entering the mass market space, when an EV start getting priced lower, imagine a Tesla that's priced the same as a Toyota. Likelihood is that you're probably gonna buy a Tesla versus I think that's just my opinion, but I think there's a little bit more upside there for Tesla in the long run. Yeah. Also, not forgetting that they do have a very strong battery business or energy storage business, which for us in Singapore we don't really see, because a very good electrical grid and very stable supply. But in a lot of other countries, especially developing countries where electricity is not, or stable electricity is not really given, they're really making a lot of headway there. Although it's not really, it's more of a long-term project for right now. Yeah, hope that helps. So another question here. With the latest weak ASML results versus good TSMC results, how do you evaluate the semiconductor industry? Yeah, so like I mentioned earlier, I think with the ASML results, it's pretty bad. I think, but a lot of analysts were expecting relatively weak earnings and relatively weak bookings. Maybe not as weak as they announced, but the good news is that the commentary that came out was that the second half would be a lot better, and that's something that they've mentioned over the last few quarters, that look for more towards the end of 2024 and into 2025. And then on the flip side, TSMC had pretty good earnings, beat on both the top line and their bottom line. But in the commentary, they did mention that they actually revised down their expectation for the semiconductor industry growth to about 10% from its previous expectations of higher than 10%. So it's a bit of a mixed bag there. I think that's kind of, like I mentioned earlier, a representation of the semiconductor industry. They're kind of there are a lot of moving parts, and they're all growing at different rates. And so it's very difficult, and they're all very cyclical. Even the components within the semiconductor industry, a cyclical industry in itself is very cyclical. And it really all depends on demand and supply. So, if you want to think about the semiconductor industry, I think you probably have to take a longer view if you want to get rid of a bit of the noise and look past the volatility. They'll still be in demand at least 5-10 years from now, given assuming that all goes well with AI and industry wide adoption happens, we will definitely start to see, or you actually stand to start to see, longer term benefits from this demand. Yeah, so I wouldn't take, it's difficult to look past the quarterly results, but at the end of the day, when you're looking at a lot of these industries, you got to look a little bit longer term for if you're going to make investments and you're going to evaluate the industry. Yeah. So I'll just keep running through the questions. What's your view for the big drops of AMD from its peak, and how do you derive your TP of 195? Yeah, so our TP, we issued it during their last earnings call, so fourth quarter 2023. It's based on a DCF computation discounted from 2025. Yeah, so my view is that it was kind of inevitable that will happen. I think it was when you look at the chart, it was really going a little bit too far. Investors were pricing in, if you're talking about Nvidia, then yes, that kind of makes sense. But when you're looking at AMD, a company that right now, AI GPUs, aren't that big component of their overall revenue. They still have a lot of levers that are dragging them down. We just felt that was a little bit too high, too fast. So nothing surprising from the correction there. In terms of the short-term spike and then the short-term kind of pullback. Yeah. Yeah. So I have a couple questions here on Google. Alphabet is already past the target price of 155. Yeah. So Alphabet actually surged past the price, I think, because they had news on, partnering with Apple to use AI on Apple phones. But essentially, this target price was derived similar to AMD. It was derived at the end of the fourth quarter earnings. And so, it is a little bit outdated. But I think when you look at long-term picture, we still see quite a bit of upside to there. Yeah. A lot of times, given the volatility in the market, it's quite common that actually, you take a good example is also Nvidia. I think they hit our 970 target price and then kind of sold off quite a bit. Look at some of our other companies like Spotify as well. I think just given the fact that markets are so volatile, they go up and down so quickly, it's very difficult for us to I guess keep up to date with the pricing. Just because the moves can be so ridiculous. Yeah. So long term, we still see a lot of upside for them. And that's why I think we have a accumulate recommendation. So another question here: what is the variable on the y-axis of the Tesla BOE chart? So try and get it out. I believe it was yeah. So I believe it's just we would just rebase it to 100. Yeah. So it's just 100 is basically your baseline. Of that is how many percent up and down. There's a question here, still not clear on the buy and accumulate. Please elaborate. Okay, so essentially, buy is a strong buy, and accumulate is a buy. And so how it's derived is just based on math. If our target price has more than 20% upside, then it's a buy. If it's between compared to the current price at the time, if it's between 5 to 20%, then it's an accumulate. If it's -5 to +5%, then it's a neutral, and then for reduce and sell as well, it's basically just instead of positive, it's just negative. So essentially, it's a lot of it's just a rating system. A lot of the other houses, they just have buy, hold and sell. For us, we have buy, accumulate, neutral, and sell and reduce. So hope that's a bit clearer for you. Yeah, I think maybe we have a few more questions for some TA questions for Zine. Maybe I'll let him take that first, and then or I'll leave it to the rest of my colleagues to see if they want to pick up some questions, and then I'll get back to answering questions John. Thanks.
Thank you, John. So there was one question with respect to Salesforce. So Salesforce share price has dropped to about $175. Any reason why, and should we accumulate the stock, particularly for long time holding? Is it a compounder stock? So basically for Salesforce, the stock, it fell by about 7 to 8%, I believe, last in the previous few sessions, and it was mainly because it was on the news or reports from Wall Street Journal that it's on the verge of acquiring the enterprise data management company, which is Informatica. So it's and the estimated deal value would be about $11 billion. So this would be the highest of deals in terms of the dollar terms for Salesforce. So maybe investors were a bit cautious. So Salesforce, it's basically the acquisition. It would boost the company's data integration and management capabilities with the help of Informatica's product suite. So in terms of compounder stock, we believe that Salesforce, it has been reporting a stable revenue growth rate over the last couple of quarters of about 11%, and we expect that to continue mainly because of its multi-cloud, rising multi-cloud adoption. So wherein through its customer 360 platform, it's basically bundling all its products under one roof, wherein also the number of deal size wherein several products have been integrated. The last deal size, it's witnessing a strength in that. So we do believe that it's a compounder stock, and it's also been focusing on expanding its margins and with a focus on profitability. So overall, for Salesforce, we have a target price of $323 and accumulate recommendation. So there was another question with respect to Palo Alto Networks. So what is your view on Palo Alto Networks? So Palo Alto, it basically provides cybersecurity solutions to enterprises and governments. So for Palo Alto, it has been the revenues, it has been like moderating over the last couple of quarters. In the December ended quarter, it reported a revenue growth rate of about 20% range. Whereas over the earnings call management, it had highlighted that for the March ended quarter, it expects the revenue growth rate of about 14%. And this is quite a significant drop, and it highlighted that it's witnessing delayed contracts from the US governments, and as a result, also because of macro uncertainties, the contracts, they have been getting delayed. So that's all for me. I would now like to pass it on to the rest of my team. Sorry, there was another question with respect to how about PayPal in future. So PayPal, it's one of the leading online payment processor solution provider. So overall for PayPal, it basically has the number of users like about I think about 240 million users, wherein about 200 million are for the consumers, wherein about 35 million or so, they are the merchants. So PayPal, it enjoys benefits from two-sided networks. So it basically charges fees when a customer, it basically uses PayPal platform to buy any product from the merchants through its PayPal service as a checkout solution. So for PayPal, like the payment volumes have been growing over the last couple of quarters, and it's witnessing a strong strength in e-commerce. So with as the e-commerce spending it increases, the payment volume on PayPal platform is likely to grow. And also it's it enjoys two-sided network effect benefit. So overall, for PayPal, we have by recommendation and with a target price of $83. So would like to pass it on to the rest of my team.
Yeah, thanks, Ambrish. Yeah, maybe I'll take this on before I hand it over to Zain for the TAs. Yeah, I think there's one question about Citi. Yeah, so we don't cover Citibank, but maybe I'll just give my view. It's quite, volatile for now. If we look at the recent first quarter results, it's all above expected, over the market expectations, right? Their revenue and their earnings. But, earnings did fall 27%, and this was mainly due to the FDIC charges, as well as their restructuring and other costs as well. So for Citibank, it's really quite volatile because it's mainly due to their restructuring. The CEO is doing this huge corporate overhaul, and it's quite hard to see, to predict for Citibank at least, because the severance packages they're giving will eat into their profits because of the higher expenses and their costs. So it's really quite hard to see moving forward. But if you look at the positives, at least we can see that their investment banking revenue did jump 35% year on year. But then again, so did all the other big banks. So a lot of the positives were also experienced by the other banks. And again, the negatives as well were also experienced similarly by Citibank with the other banks, like the net interest income not being as good as expected, and the net interest margins sort of plateauing. Yeah, so I think it's basically, if you compare it to the other banks, it's like it's a bit of a gamble because you're taking a bank with a current restructuring process that they have not yet sort of fully completed. So yeah, hope that is clear. We'll hand it over to Zain for the TA. Thanks.
Thanks, Glenn. I'll share my screen to talk about the TA. Okay, first up, I'll share about Apple. I think Apple is currently doing some sort of a range-bound movement between 168 to about 170 over here. Recently, after price touched near the highs of 178, we saw a pullback take place. But I think for now, it should gain some footing around 165 to 168, where it was the recent support level as well as the prior swing low support back in the October lows of last year. Yeah, so I expect some bounce move from the lows at this support zone. Then the next one is on Google. Okay, I think Google is currently still one of the stronger names in the tech space for now. Looking at the price action wise, it's still trading in this uptrend channel in highlighted in blue. I think you could still see the price sort of sideways for the time being with the support at 154, 155 over here from the prior highs as well as the channel support. So you could see some sort of a bounce take place back towards 159 to 160 in the near term. Then next one is on Meta. For Meta, I think some short-term pullback, but overall could be still trading in generally a range for now. So price has pulled back from the resistance close to 520, which was a swing high over here, as well as we have this trend line resistance as well. I think we should be able to see price gain some support at the $480 level, where is a strong support over here. Yeah, I'm expecting some sort of a bounce move to actually just continue in the range for the time being. Okay, Okay, next one, moving on to Nvidia. I think Nvidia is currently showing some weakness after price broke down this standing boarding wedge highlighted in blue. Yeah, so recently there was a break and then a retest following which further weakness came in. So I think for now we should be we could see the price go on to fill this gap over here close to 820. Recent low support was around 830. So I think price could gain some support from a bounce at these levels and do some sort of a sideways for the time being with resistance still around 880 for the time being. So it could just sideways for a while. Next one is on Intel. Okay, for Intel, I think some weakness still for the time being. We've seen price continue a pullback after it broke down of a range between about $42 to $45. Looking at the longer term wise, it also broke down below this uptrend support line as well. We could still see some further pullback momentum if the price continues downtrend towards close to 33 to 34 area, where previously it was quite a strong horizontal level over there. Then we might see the price of redo a slight rebound over there. But overall, for now, the trend is still quite weak. Okay, next one, I'll talk about Tesla. Okay, for Tesla, I think generally still some weakness for the time being. Recently, price broke down below 160. This support level, but it did a retest of 152, 153 level, which is this descending wedge trendline support over here, which is also confirmed with a previous swing low back in April last year. So I think if the price can hold this level, we should see some sort of a sideways for the time being, with short-term resistance around 160 level. Okay, then the next one I'll talk about AMD. Okay, AMD is I think it's still seeing short weakness after price couldn't hold the 162 range support level of February this year, and then we saw a sell down yesterday, close to the next support level at 150, 151. And then price could retest this level. Then we could see a bit of a bounce take place, but I think it will be a modest bounce given the strong downtrend we've seen in this counter. Okay, I think I'll just hand over time back to Jonathan to finish up some of the other questions. Yeah, thanks.
Thanks, Ian. Let me share my screen real quick. Let me just try and run through a few more questions before we end off at 9. Getting a bit late. Okay, so I've got a couple questions here on Bitcoin and on Marathon Digital. What is the outlook for Marathon? Do you think Bitcoin prices will trend higher after the halving? So the short answer is no, it probably won't trend higher immediately, but I think if you look at the long-term trends, especially as you look at the previous halvings, it's always kind of gone up over time. When you look at some of the companies, like Marathon and Riot, really their valuations are almost solely based on the pricing of their assets, which is Bitcoin. So they're very essentially, if you want, there are companies that you should buy if you want exposure to Bitcoin without buying Bitcoin. Yeah, I mean, I can't give you much of an outlook because they're super tied to Bitcoin prices, so it's difficult for them to do well if Bitcoin prices go down and vice versa. Yeah, hope that helps. There's another question here. Is it good to invest in US dividend stocks? So I think it depends. Because I mean, if you're in Singapore, or rather if you're outside US, you're still gonna get charged your 30% on your dividends. So if you want to invest in high dividend stocks in the US, you must better take into account the 30% tax that come off the top. But if you think about investing in dividend growth companies like Apple or Microsoft, technically, or even Nvidia, technically they are dividend stocks and they grow quite a lot. The dividends have grown quite significantly a year. But overall, not really a good idea to invest in them per se. It's 9 o'clock. I'll take. I guess there are a few questions here on the semicons. Maybe I'll try to take all of them. Most of it over here, the first question is, with the disappointing results by ASML, are you concerned that tech earnings have peaked and that tech stock share prices have also peaked? A little bit. The short answer is yes. I think a lot of the near term, or at least a lot of the prices of these stock companies, of these semicon companies and tech companies, a lot of the upside has been already priced in, and so any little bit of a downside or a not significant upside surprise, you should expect some sort of pullback. And it's just normal with the market rally. I think it's just a healthy rally. People taking profit and just a little bit of a pullback. Yeah. Further on to this question, ASML earnings were affected by US restrictions. Do you expect Nvidia will be affected too, especially after the second quarter? So actually, Nvidia already came out to say that and in their last earnings, their fourth quarter earnings, you could see the revenue from China drop quite significantly. I don't have the numbers offhand, but it's a very significant drop, and it's something that they already expected because for Nvidia, that I think the restrictions kicked in in October 1st, if I'm not wrong, somewhere in the back end of last year. And so they're already feeling the effects of it. But the good news for Nvidia is that a lot of their customer base, or rather, they're seeing a lot of the demand coming from outside of China as well. So that's helping to offset some of the decline in chips that they can sell to China. Additionally, they've also made lower spec chips to sell to China because the restrictions are mainly for their higher end GPUs. Yeah. Okay, last question here I'll take. Sorry, last question here. And also on semicons, what's your view on TSMC earnings and outlook? Price drops in pre-market after the earnings report today. Yeah, so the good news is that you're starting to see some growth in the foundries, which is good news for overall semicon industry, because they're basically building the chips for everyone. So if their numbers start to go up and their guidance, shows a more sustainable growth trend, then that's good for everyone. The main reason the price drop, I think, is because they revised down their overall industry outlook for 2024. But they've always been very vague on it. Before the last quarter, so in the third quarter of last year, they said that they don't expect any growth in 2024. And then in the fourth quarter, they said they expect high or double-digit growth, which is very vague. And now they said they're going to expect 10%. So it's like kind of, it's just, I'm not quite sure why they're so vague on it. But overall, it's just, I guess, to give investors a gauge on how do you think the industry is growing. I mean, 10% for industry, 10% growth for industry is actually very good relative to a lot of other industry. So it may not be like the heydays of COVID with a lot of tech companies at 20-30%, but 10% seems still pretty good. Yeah, so overall, I think quite positive for TSMC in terms of your longer term outlook for the company as well as the whole overall semicon industry, just by numbers alone. Yeah, so I think that's all for the questions that we can take right now. If you have any more questions, feel free to post it on our P3 community. At the same time, after this session, we'll also try to answer some of these questions and post it out there so you can go and take a look. Yeah, so with that, I'd just like to thank everyone for joining us. So I'll hand it over to Roshan to kind of end this webinar and say goodbye to you all. Thank you.
All right, thanks, John. Thanks again to our speakers for the presentation and interactive Q&A. We have now come to the end of the webinar, and we would like to thank you all for joining. For tomorrow, we will have Tomoyuki Misumi, research analyst from Phillip Securities Japan, to present on the Japanese market from 1 p.m. to 2 p.m. Remember to mark your calendars. It's tomorrow, the 19th of April, Friday, from 1 p.m. to 2 p.m. For the session just now, we will be uploading the recording on PhillipCapital's YouTube channel. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Do take your time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code on the screen. You may also join our investing communities. to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us, and we hope to see you tomorrow. Stay tuned, take care, and have a nice evening.